Turkey's central bank has announced a raft of new measures to prop up the markets and the Turkish lira amidst the ongoing uncertainty. Let's get more on that now with Timothy Ash, economist at BlueBay Asset Management. Timothy, thank you very much for joining us. This comes after a meeting with commercial lenders on Sunday and includes a ban on short selling. Will it be enough?
Well, it's one of many measures, as you've mentioned. I mean, the positive for the central bank is, they came into this crisis with a real wad of foreign exchange reserves, about $160 billion gross reserves. That's a lot of ammunition to defend the currency. Also today, interestingly, Erdogan came out with strong supportive words for Şimşek, that's the finance minister, and the team at the central bank. And they have, I think, a mandate to do whatever it takes to stabilise the currency and stabilise markets. That could mean raising interest rates. The benchmark rate has been reduced in recent months, but we could see that increased in defence of the currency.
Well, let's maybe talk about interest rates in a moment. What impact do you think that the political unrest continuing will have on foreign direct investment?
Well, there are two things here. There's foreign portfolio investment, which is foreigners buying stocks and bonds. And then, as you mentioned, foreign direct investment, that's companies, building factories in the country, in Turkey. We've seen portfolio inflows return to Turkey a couple of years, not to the record levels we saw a decade or more ago, but kind of significant levels, and probably around $50 billion worth. Significant amounts have left in the last week, frightened by this move. But the central bank has used reserves to cushion the outflow. Now, if we see some kind of normalisation on the politics front, or demonstrations moderate, and if we see the central bank do the orthodox things in terms of raising rates, etc., that money could come back quite easily, I think. The more difficult one is foreign direct investment. People, when they build factories in countries, they're more concerned about rule of law, long-term political stability, and I guess that's been hurt by the end. So I think foreign direct investment, will further slow. Actually, interestingly, the peak of FDI, foreign direct investment, was, I think, in about $30 billion a year, and it's been down to around $5 billion recently, and that's probably going to go lower as a result of that.
And where do you think this does leave interest rates? And is President Erdogan willing to risk another economic crisis for political reasons?
Well, it depends what you mean by economic crisis. A currency crisis, which results in high inflation, I think he doesn't want that. I mean, I think if you look at the results of last year's local election, it was really about inflation. I mean, the ruling party, the AKP, got a drubbing across the country because people were fed up of high inflation. And I think, what he learned from that was that he needs to address those inflation problems. And he appointed a team, Şimşek and the guys at the central bank, to address those issues. They raised rates. We've seen some progress in terms of reducing inflation. It's been on the right track. Obviously, this has put that effort out of kilter a bit. But I think, policies that, a failure to address the challenges, the market challenges in the short term, if they resulted in a big FX adjustment and high inflation, I think that would be terminal to Erdogan's re-election chances anyway. So he can't really let the currency go. He's got to continue to support the orthodox monetary policy run by Şimşek and the team at the central bank. He has really no option.
Great to get your insights today. Thank you very much indeed. Timothy Ash, economist at BlueBay Asset Management.